Meanwhile, I want to bring in Bell Point Chief Strategist David Nelson. And David, even before we get to this jobs report, you have written in your recent note about the elephant in the room, being the same elephant that's been in the room since March of 2022. What is that?
It's rates, but only this time the elephant's a lot bigger. And it's not about the short end of the curve. I actually think the Fed is largely done, and I don't think they're the problem anymore. I think for bond traders, what they're looking at debts and deficits that are ballooning out of control. It wasn't that long ago that we had a deficit of $1 trillion annually. Now it's $1 trillion every 6 months, and exponentially that is going higher. That's a major concern for bond markets, certainly a major concern for investors.
I'm glad you said that. I am seeing that too. I'm hearing a reading where economists on Wall Street who are predominantly limousine liberals and maybe reluctantly saying, hey, we are actually spending too much money. I mean, but the other side of that is the buyers aren't there anymore. China's selling like crazy. Japan, now we've got competition with Japanese yields. The Federal Reserve is letting bonds roll off. I mean, so you've got more supply, a shakier economy, and no buyers.
Bond traders want some food on their plate. If they're going to extend duration, they want to be paid for it. And they've looked at what happens in Washington. This is a global event as well. This is happening around the world. And add the fact that you have a Federal Reserve that is rolling off their balance sheet. That's about $60 billion a month. That adds more supply.
Right. And around the world, particularly in Western nations, right? I mean, it feels like we've all kind of gotten used to, we got used to this. Initially to the easy money and then having to make the adjustments to the easy money. And the pendulum swings so quickly. I don't know how anyone can even talk about business cycles anymore. They don't exist.
They're gone.
Right. The bond market, though. Wall Street loaded up on bonds for a few months. More recently, BMO saying, hey, let's wait. Before a month ago, they were saying it was a screaming buy. Michael Hartnett over at Bank of America says, without a doubt, in his mind, bonds will be the best performing asset in the first half of next year. Where are you? Should people be buying these bonds? I got to see a change in Washington for myself. Look, Americans are pretty frustrated with what they see. They're not seeing any change. Everybody's piled into the short end of the curve. That's where I live right now. But as a society, we're going to be putting more and more capital into bonds. Insurance companies, pension plans get it. They're pulling money out of the stock market because they don't need it anymore. They can match liabilities with another asset class like corporate bonds. We're going to be doing that too. They're the only ones who can do it, though. I mean, look what happened to Silicon Valley Bank. They said this is a risk-free investment. Who would have ever thought one of the biggest bankruptcies of a bank in history?
That's the bigger elephant in the room.
Right, because on paper, hundreds of billions of dollars are being lost right now on paper.
What's lurking under the surface that's even bigger than that is the fact that 10-year rates are now 75 to 80 basis points above where they were in March, a level, mind you, that caused the collapse of Silicon Valley and Signature.
Right.
That's something lurking under the surface that kind of gives everybody pause.
In the meantime, stock investors have been told, hey, you know what? If you're going to stay in the market, get out of those mega cap names that are rocking. They're too expensive. All year long, they've been told you want to be defensive. Utilities getting hammered. Today, the worst performing sector is staples. So, you know, again,
widows and orphans aren't safe anymore.
Investing, widows and orphans. You know what? We need a special fund for them because really, it's not so paint by numbers. This old Wall Street strategies, all of them, one by one, failing.
They all failed, and we're all, you know, we kind of look in the rearview mirror to try to get a direction. Look, I'm still out there plugging. There are still stocks that I think you can buy, but I think we're going back to that 60-40 portfolio. Only 60-40 isn't going to morph into 90-10 like it did over the last 10 years. 60-40 is going to actually work. Have part of your money in bonds, part of your money in stocks. It's going to be a good place to be.
But it's not, right now, it's not a good place to be. It hasn't been in the last 2 years.
It can be if you're on the short end of the curve. There's nothing wrong with a 5% T-bill.
Okay, so and everyone's loading up on the T-bills. I mean, when everyone loads up on something, is there any risk? I just keep, again, you're right. I mean, it seems like easy money, right? And at some point, that kind of
it's a good place to be for your safe cash. You're not going to have all your money in NVIDIA. You know, it's a great company. I love it. I own it. But there's going to be other places to put cash.
I got you. Great stuff, David.
Thanks
really appreciate it, buddy.